So we're back again with another guest at NICC 2023 here in Montreal, and this is Nadja Dref, who you are with DBRS Morningstar. And you are a rating agency, obviously, that serves a number of different industries, but today we're going to talk about insurance and how you sort of provide services and what you do for the insurance agency and maybe some things you're seeing within it. So Nadja, thanks for sitting down with us. Welcome to the show.
Well, thank you for having me.
You're very welcome.
It's a real pleasure.
Before we kind of talk about DBRS, what's your background? How did you get into this position? What do you see in the insurance world, and how has your journey evolved to get to this point?
All right, so you want me to talk about myself?
Yes, that's the easy stuff.
No problem. So I joined DBRS Morningstar about 2 years ago. I was previously with Insurance Bureau of Canada.
Okay.
Prior to that, I started my career as an economist at the Bank of Canada. So that's sort of my background as an economist, but been in and around insurance industry for some time. With DBRS Morningstar, like I said, for just over 2 years. As you mentioned, we do credit ratings. We provide credit ratings within the insurance market for both P&C and life insurance companies. I mean, in terms of the coverage, we have very good coverage in Canada. On the life side, almost all of the market, I would say about 80%, all the big life insurance companies.
The Canada Lives, the Sun Lives, those kind of entities.
You got it.
Yeah. I'll name them, you don't have to. I'll guess your clients.
Public information, so absolutely. And then of course on the P&C side, we also rate companies such as Intact, Fairfax, Definity. Those are some of the bigger ones.
So let's talk about rating. For a lot of people in the insurance industry, depending on where you sit in it, you understand this happens, but what is the purpose of it? What does it mean, and how is it used by the industry?
So from my perspective, so I'm on the analytical side, so the team that does the actual credit ratings and provides those to the issuers, and in case where they're public ratings, those are ratings that are available for their use publicly as well. So the process goes like this. We have a methodology that is public and it's available for our current and potential clients. And it really outlines how we approach a rating. And so it goes through our what we call a building blocks, so where we assess, for example, franchise strength. We want to look at the company's market position, their operational excellence in our assessment of it. We want to look at also the competitive environment in that particular industry or that line of business. There's obviously risks and how they manage those is very, very important. There is capitalization and liquidity. So there's a bunch of different factors that we look at. And we take all those different scores, if you will, and ultimately produce a rating. The highest AAA, and then all the way down.
So when you look at different things, do you take a look at things like where companies are expending money on innovation and strategy as well? Does that go into rating too, and how you consider what they're doing?
Well, that's a very good aspect of assessing one's operational excellence, I would say. And strategy is a big part of what we look at, because as a credit rating agency, we try to distinguish ourselves as being forward-looking. So we'll look at your numbers, financial statements, absolutely. But that information is in a way backward-looking, right? That's how you've done.
What you've done.
What you've done. But we would like to know what is coming ahead so that we can assess the company in terms of where we see it going. Is it going in the right direction? Is it investing in the appropriate issues and what is on the horizon, as opposed to just managing as it always has? Because that's very, very important. So it does go into one of our more qualitative assessments.
Are there any trends that you're seeing when it comes to the data and what insurance companies are doing to achieve good credit ratings and a positive impact from your agency?
So let me just distinguish in terms of our analytics. They're not predictive in terms of the way it's used in the industry of, underwriting aspect. What we try to is assess the credit quality of the company. That's more forward-looking. And what goes into that is a number of different factors. One of them being strategy. Are they investing in the appropriate technologies? Are they addressing emerging risks in an appropriate way? But others are kind of more basic, like are they well capitalized, liquidity management and such. And so obviously some companies are going to be more at leading edge and others are going to be more on the follower side. But those are just kind of marginal factors. Like it wouldn't be necessarily a very big component of,
So who then, do the companies themselves use the information you provide in terms of the rating and what you give them as so AAA or AA? What do they do with that information? Does that help them get funding, go to market, bond issuances and things like that? How is it used?
Yeah, so the example you just gave is perfect.
Right for once.
So we have something what's called a financial strength rating.
Yeah.
And that assesses ability of this company to serve the policyholders. And that's our assessment of it. But also when companies issue debt, we're able to rate that debt and then tell the market where we see the quality of that bond, for example.
Interesting. So what about the Canadian market then, whether it's life or P&C? Is it a strong market for insurance companies, and are they well managed when you look at it from a point of view when it comes to their rating, when it comes to their debt? Are we in good hands with these companies?
So
Sure, I'm putting you on the spot. You don't have to name names.
I'm not naming names. And, the best way to answer that question is really to have a good idea of ratings more globally.
Yeah.
We see a lot of the ratings in Canada, and having the ability to also rate companies outside of Canada, which we do, does put them actually in a very good light.
Yeah.
And it's very sort of objective in the sense that each company that we rate does have a rating.
Yes.
The ones in Canada, I would say the regulatory environment is a big part of it. So a lot of things that companies do in terms of risk management, they do it in a way that we would expect and that we find is robust and appropriate. And that does put them in the good camp.
Yeah.
Also on corporate governance, we find it to be quite strong, and partially because they're also satisfying regulatory requirements. That could be part of it. And then obviously market conditions are also a big factor in how well a company does. We've had, I would say, resilient markets over the last little bit, notwithstanding obviously the very large number of catastrophes, even just this year.
That's been a common theme in our conversations today is the cat loss and the ramifications of it and the frequency. Exactly. Is that something that you consider when you're looking at some of the ratings too, is how well and how frequently insurance companies have to respond to cat loss?
Absolutely. I mean, the big part of why we have and their purpose of property and casualty insurers is to service these claims, and that is the social purpose that they have. And so the way we assess in their ability to pay and actually still make a profit is through something called the combined ratio.
Yep.
You're familiar with it.
Oh yeah.
Yes. So that is one of the inputs into our profitability block, for example, and obviously a lot of natural catastrophes would impact that.
Yeah.
If it's not properly mitigated, but obviously there is mitigation tools as well.
Yeah. So let's talk about the combined ratio, because it's sometimes cited by certain companies to say this is where we're running on our core combined operating ratio. And what does that mean? When you look at a combined ratio, in a not a literal sense, but a figurative sense, in a perfect world, what do you look for? Like, what kind of number do you look for to say you are in good territory?
Right. So our methodology, which I already mentioned, is actually outlines the ranges of what we consider to be excellent and all the way down to not so good. So, a combined ratio under 90% would be considered really good.
Given some of the years we've had, that would be a very nice thing to see.
Not easy to achieve.
No, it's very difficult.
We do try to take a bit of a longer term and a little bit more of a forward-looking perspective. And when I say longer term, for example, for the combined ratio input, we will not look at just that particular quarter or even just that year. We'll look at a weighted 3-year average, for example, because we understand that natural catastrophes are not predictable and there could be substantial amount of volatility.
I think one of the interesting things about insurance is, and I know it was Carol Jardine, who is the former president of the Canadian operations for NICC, used to say, she goes, if I remember correctly, she said to me a number of times, very few industries pay out close to 70 cents on the dollar that they take in back to their customers' hands, which I think is quite a commendable thing about insurance, in that it's because they take their financial wellness and ability to pay that back so well that they can do it, right? And by being held account by having rating agencies like yourselves do this, it holds them to account to make sure that the consumers are going to have something when they need it.
Absolutely. That commitment to satisfy policyholder obligations, that's at the core of what we try to assess as a credit rating agency. And people often forget, or I mean, maybe they don't forget, but it's a very good point to be made that the money that goes into the insurance company, is ultimately there to pool risks so that those that do make a claim when an unfortunate event happens, the money's there to help those who don't need it. And so, obviously, something to be said about
It's the core function of insurance, and it needs to work when people need it. So speaking, lesser serious topics, how have you been so far at NICC? What are you excited for? Some of the sessions, anything you're looking forward to seeing in the next day or two?
Just came out of a session. It was fascinating with PASIC.
Oh, okay.
And it was actually talking about potentially creating a bridge insurer. So something new that we currently don't have in the system. And it's all for the purpose of having a resolution mechanism should an insurance company fail that is more viable and that is not going to place a very excessive burden on the industry. As you know, currently is the survivor pay model. So we know that there's this potential for companies that are doing everything right to be stuck with the bill, as Alistair would say, that they have to, that invoice that they have to pay. So that's something we do think about, and we're watching closely to make sure that the industry finds the appropriate resolution mechanism.
Interesting. That's a session I wish I'd been able to do, particularly because of Alistair. He's the best quote in insurance, and I hope that never changes. I long to be as good as him with the microphone and his wits. When it comes, you talked a little bit about regulatory environments and some of the conditions that insurers are involved with there. Do you look at the regulators themselves too and consider what they're asking for in some of your rating models and how you come up with your determinations?
Yes, a perfect example of that is capitalization factors. So we don't have our own model where we would feed it input in order to assess some sort of a capital level that we would like to see. Instead, we rely on the solvency ratios by the regulator here in Canada. It would be OSFI's minimum capital test. Obviously, we study the ratio and how it's composed and what factors would change it. But ultimately, we do rely on it for our ratings, and that we see as an advantage because we understand it and we think it's a good measure of capitalization.
Fantastic. Nadja, thanks so much for dropping by. Have a wonderful time tonight at the gala, and a great day too at NICC.
Thank you so much. You as well.
Very welcome.